Watch the screen, not the card, not the customer. The screen, approved, one word, less than a second. £100 purchase is complete. At least that is what it looks like. Reverse the moment. Before that word appeared, the shop sent a request to a company the customer may never have heard of. That company passed it into a private financial network. The network found a bank, possibly thousands of miles away, and asked a question. Is this card real? Is the account funded? Does this purchase look like fraud? The answer raced back through the same chain, but the money did not. The money comes later, and when it arrives, the shop may not receive the full £100. A fee has been removed, divided between different businesses, under contracts, regulations, and price schedules hidden behind that one word. Most customers will never see the division. Many merchants struggle to predict it, and the companies at the center of the system process hundreds of billions of transactions while rarely lending the customer a single pound. This is not the story of a piece of plastic. It is the story of the infrastructure underneath it and the hidden business behind every card payment. Credit began as a relationship. A shopkeeper knew a customer, wrote down a debt, and trusted that it would be paid. Larger stores turned that relationship into an account. Some issued cards, but those cards were islands. A credential from one merchant meant nothing to another. In 1950, Diners Club helped popularize a card accepted by multiple businesses. In 1958, Bank of America launched Bank AmeriCard, combining a general-purpose payment card with revolving credit. The difficult part was no longer making the card. It was building acceptance around it, recruiting merchants, connecting banks, managing fraud, and creating rules that worked beyond one institution. Banks began licensing systems and forming alliances. The Interbank Card Association was created in 1966. Bank AmeriCard became Visa in 1976. MasterCharge became MasterCard in 1979. The names changed as the networks expanded. The underlying breakthrough did not. A customer of one bank could now buy from a merchant served by another. Neither bank needed to own the entire relationship. They only needed to recognize the same rules. That agreement is still operating inside the terminal today. Return to our £100 purchase. The person holding the card is the cardholder. Their bank is the issuer. It issued the credential and controls the account or line of credit behind it. The shop is the merchant. Its financial provider is the acquirer, the institution giving the merchant access to the card system. Between issuer and acquirer sits the network, Visa, MasterCard, or another scheme. A processor, gateway, or payment facilitator may add the technology the merchant actually uses. One provider can bundle several services, but the core functions remain distinct. When the card touches the terminal, authorization begins. The terminal creates a message. This merchant, this amount, this credential, this moment. It travels through the merchant's provider to the acquirer. The network reads the credential and routes the request to the correct issuer. The issuer decides, is the card valid? Is there enough money or credit? Does the purchase fit the customer's behavior? Was the correct security method used? Do the signals resemble a genuine customer or a stolen account? Approve or decline? The decision returns to the shop. That is the transaction we see. But authorization is not final payment. It is a promise that the payment can proceed. Later comes clearing, transaction records are checked, and the obligations between institutions are calculated. Then settlement, banks settle their net positions, and the merchant's provider pays the shop according to its contract. Information moved first, money followed later. What felt like a transfer was actually an agreement, coordinated by a network in less time than it took the customer to lift their hand from the terminal. Now the £100 reaches the other side. Except the merchant receives less. What disappeared? The merchant usually pays a merchant service charge. It may arrive as one simple rate or hundreds of detailed fee lines. Either way, the price is not one company's revenue. It is a stack. The first layer is interchange. In a typical four-party transaction, interchange moves from the acquirer's side to the issuer, the customer's bank. It helps fund the issuer side of the system, the account, authorization, fraud controls, and in a credit transaction, the risks and costs surrounding the lending relationship. The second layer is made up of scheme and processing fees. These go to the network for participation, routing, processing, and related services. The third layer is retained on the merchant side by the acquirer, processor, gateway, or payment facilitator. It can pay for checkout software, merchant underwriting, fraud tools, reporting, support, and payouts. This is where the popular story goes wrong. Visa or MasterCard does not simply pocket the entire fee charged to the shop. Interchange generally belongs to the issuer. Network fees belong to the network. The merchant provider has its own price, one deduction, several businesses. The exact division can change with the country, the card, the merchant, the sales channel, the risk, and the contract. Under interchange plus pricing, several components can be displayed separately. Under blended pricing, the merchant receives a clean headline rate while the wholesale split remains behind it. Consider a published UK example. When this film was researched, Stripe listed a price of 1.5% plus 20 pence for a standard UK card accepted online. On a £100 purchase, that is a charge of £1.70. £98.30 remains before the merchant's other costs, taxes, refunds, or adjustments. That does not mean the network received £1.70. The published blended price does not reveal the exact internal division, but it reveals the merchant's reality. A business can make a sale for one amount and receive another. Follow interchange to the issuing bank, and the economics shift again. A debit card connects the payment to money already held in an account. A credit card also creates a loan. That credit card relationship can generate several kinds of revenue. Interchange when the card is used, annual fees for the account, and interest when a customer carries a balance. Other cardholder fees may apply. Against that, site rewards, operations, fraud, and the losses created when borrowers do not repay. This is the machinery behind points, miles, and cashback. Rewards make one card more attractive than another. The card moves to the top of the wallet, more purchases flow through it. That creates more opportunities for the issuer to earn and more reasons for the customer to stay. Interchange contributes to that system, but rewards are not funded by interchange alone. The issuer is pricing the whole relationship: spending, borrowing, fees, benefits, loyalty, and risk. Regulation can alter that equation. In the United States, the base interchange received by a covered debit card issuer is generally limited to 21 cents plus 0.05% of the transaction value, with a possible 1 cent fraud prevention adjustment. Smaller issuers can be exempt. That is a rule for a particular layer of U.S. debit payments. It is not a universal cap on credit cards or merchant fees, but it exposes something important. Change one line in the fee stack, and the effects can appear elsewhere in rewards, account pricing, product design, or the customers a bank most wants to attract. The fee is not just the price of moving money. It is part of the incentive system that determines which card the customer reaches for in the first place. Thousands of issuing banks compete for customers. Thousands of merchant providers compete for businesses. Between them, two names appear almost everywhere. Visa states that it is not a financial institution. It does not issue the underlying cards, set cardholder interest rates, or carry the customer's credit risk. MasterCard makes the same basic distinction. It does not issue the cards or extend the cardholder's credit. They built the machine connecting both sides, and once the machine operates at global scale, the economics become extraordinary. In its 2025 financial year, Visa reported $40 billion in net revenue and more than 257 billion processed transactions. From its reported revenue and operating expenses, its operating margin was approximately 60%. MasterCard reported almost $33 billion in net revenue, more than 175 billion switch transactions, and a reported operating margin of 57.6%. The companies define those transaction measures differently, so they should not be added together. But the advantage is visible in both. The network can serve enormous additional volume through infrastructure that already connects the world. Revenue can be tied to payment volume, transaction processing, and cross-border activity. Around the central rail, both firms have expanded into cybersecurity, authentication, fraud detection, data, consulting, and payment technology. The more the system must defend itself, analyze itself, and operate across borders, the more services can be built around the transaction. It is tempting to call the network a toll booth. The analogy works up to a point. A toll booth charges for access to a route. A card network also maintains the route, the traffic rules, the technical language, the brand, and part of the framework for dealing with accidents. And it pays to keep institutions using that route. Visa and MasterCard report billions in client incentives and rebates, particularly to financial institutions and other partners. Gross fee categories are not the same as the net revenue the networks keep. Those incentives are not a side note. They show how competition works inside a market dominated by a small number of schemes. Issuers want a network accepted everywhere. Networks want issuers placing their logo on attractive cards. Merchants want access to the customers carrying those cards. Each relationship strengthens the next. The result is more than a payment processor. It is a two-sided market in which scale does not merely lower cost. Scale makes the product more difficult to refuse. A merchant can compare processors. It can negotiate a contract, it can encourage a bank transfer or another payment method. But refusing the cards customers already carry can mean refusing the customers. This is the network flywheel. Consumers value a card accepted at many merchants. Merchants value access to the consumers carrying it. Issuers prefer a network their customers can use almost everywhere. Every new participant makes the system more useful to the next. At sufficient scale, acceptance begins to feel compulsory. The UK payment systems regulator concluded that MasterCard and Visa did not face effective competitive constraints on the acquiring side. It described their cards as must-take, products merchants feel commercially compelled to accept. The regulator also found that core scheme and processing fees had risen by at least 25% since 2017, costing UK businesses at least £170 million more each year. Those are the regulator's conclusions. They do not mean every fee has no value. Reliable infrastructure costs money. Fraud prevention costs money. New services can improve the system. The deeper question is whether the merchant can see the price clearly and apply meaningful pressure to it. A card fee statement can contain a maze of categories, adjustments, and notices. Leaving the dominant networks can carry a much simpler consequence: lost sales. The customer may see none of this. In the UK, surcharges on covered consumer card payments have been banned since 2018, so the payment cost usually disappears into the business, absorbed by margin, reduced elsewhere, or distributed across the prices paid by everyone. The card feels free because its price has moved out of view, and that price changes when the payment crosses a border. For a qualifying domestic UK consumer transaction, interchange is capped at 0.2% for debit and 0.3% for credit. The cap covers interchange. It does not cap the merchant's entire service charge. After the United Kingdom left the European Union, those caps no longer applied in the same way to card-not-present consumer payments between the UK and the European Economic Area. The regulator reported that interchange on those transactions rose from 0.2 to 1.15% for debit and from 0.3 to 1.5% for credit, the same looking online checkout, a regulated fee roughly 5 times higher. The regulator concluded that the increases were harmful and unduly high. Then, in July 2026, it issued directions targeting fee transparency and pricing governance. The major schemes would have to provide clearer information about what fees are, how they are triggered and calculated, and how merchant interests enter pricing decisions. This is the regulator's problem. The price is not one number. It changes with the card, the channel, the merchant, the service, and the route. Cap one layer, and another can still move. Demand lower fees, and someone must still distinguish genuine investment from the price of market power. Behind one familiar payment is a schedule of rules that almost no customer sees, and many merchants cannot realistically escape. The system becomes easiest to understand when something goes wrong. A credential is stolen. A customer is manipulated. Goods never arrive. A legitimate purchase is disputed. The payment must now travel backward. Issuers, merchants, acquirers, networks, and technology providers operate layers of defense, chip security, tokenized credentials, one-time codes, behavioral models, and strong customer authentication. The rate of fraud can be tiny, while the absolute loss remains enormous. The European Central Bank and European Banking Authority reported 4.2 billion euros in payment fraud across the European Economic Area in 2024. That was 0.002% of total transaction value. Card fraud losses alone were 1.329 billion euros. Security changes where criminals attack. The same report found card fraud was 17 times higher when the payment recipient was outside the EEA, where strong customer authentication was not mandatory. But no technical control eliminates human deception. Criminals move from stealing card numbers to persuading customers to approve payments themselves, and not every disputed transaction is fraud. A chargeback can reverse a payment when the rules and evidence support the cardholder's claim. That protection gives consumers confidence to buy from a distant or unfamiliar merchant. It can also create expense, delay, and abuse for businesses. Who bears the loss depends on the transaction, the authentication, the evidence, the network rules, and the law. There is no honest universal answer that always says the bank pays or the merchant pays. This is part of what the fee stack purchases, a system for deciding what happens after trust fails. So, why not remove the stack and use a different rail? In some payments, new systems already do. Open banking and instant account-to-account services can move value between bank accounts while bypassing parts of the card chain. Other products combine transfers, stored balances, local networks, or installment credit. But a new interface is not always a new rail. With Apple Pay, for example, the original card number can be replaced by a device-specific credential. The actual number stays away from the merchant, but the issuer and payment network can remain central to provisioning and processing. The wallet changed. The rail underneath did not necessarily change with it. American Express rearranges the chain in another way. In much of its proprietary business, one company combines more of the issuing, network, and merchant acquiring relationship, but it also works with outside issuers and acquiring partners. Even an integrated model can contain multiple paths. Every alternative rearranges the system. None escapes the coordination problem. A challenger needs customers and merchants at the same time. It needs security, reliable settlement, consumer protection, refunds or disputes, regulatory compliance, and a reason for both sides to change behavior. The hard part is not making money move. The hard part is recreating the acceptance and trust that make the existing system feel invisible. Return to the counter. The customer taps. The issuer decides. The network connects. The acquirer delivers. The merchant pays. Later, the institutions clear and settle what they owe. Every layer can point to a service, credit, acceptance, security, technology, or coordination. The controversy begins when the price is difficult to see, when the merchant cannot realistically refuse it, or when geography changes the fee without changing what the customer experiences. The plastic card was never the most important product. The product is the agreement behind it. Billions of credentials, millions of merchants, thousands of institutions, and one recognizable promise that the payment will work, with rules for what happens when it does not. The terminal says approved. The remarkable part is not simply that money moved, it is that an enormous commercial system had already agreed how to move it, how to divide the price, and who would carry the risk before the card ever touched the screen.